Greetings to everyone. You're all welcome to our channel today. Here is pros and cons accountancy tutorials. My name is Edward, and you can call me Ed. So the last time we met, we talked about IAS 16. We were able to deal with the definition, the initial recognition, the initial measurement, the subsequent measurement, the subsequent expenditure, the disposal, and then the derecognition of IAS 16. So today we want to deal with another standard in relation to assets, which is IAS 40 investment property. So the last time I made mention that if you are dealing with a standard relating to assets, a standard relating to a long-term asset, then your focus will have to be on these issues, talking about the definition, the initial recognition, the measurement, basically the initial and the subsequent measurement, disposal, and then the derecognition criteria. Right? So we will have to get to know all these things also under IAS 40, as we did under IAS 16. So now, what then is IAS 40 investment property? So when we talk about investment property is a property which is in the form of a building. It may be a land. It may be land and building together, or even part of a building, right? Which is held for capital appreciation or for rental. Let me come back again. Investment property is defined as a property. So it may be any property which is held for capital appreciation or for rental. So for rentals, or we just hold it for what? Capital appreciation. Right? So it's not like the one that we are holding for goods and production of goods and services and for administrative purposes. No. This one is basically for capital appreciation, what? Rental. So we are saying it is in the form of what? A building, right? Land, part of a building, or land and building together. That is the idea for investment property. The last time we met, when we were talking about the initial recognition of an asset, we said economic benefit, future economic benefit should be able to flow from the asset to the entity. So this is also an asset, right? So the recognitions, the initial recognition that goes for PPE, which is the IAS 16, is the same thing we are going to have here. That two recognition criteria. So we said economic benefit should be able to flow from the asset to the entity, and then the cost should be measured what? Reliably. We should be able to measure the cost reliably before we can recognize it as what? Asset in our financial position. So for you to be able to recognize it as an asset in your financial position, these two criteria should be met. And that is future economic benefits should be able to flow from the asset to the entity, and we should be able to measure the cost of the asset reliably. So that is the initial recognition, same as we said for IAS 16, property, plant, and equipment. Now, what about the initial measurement? So let's talk about the initial measurement. Initial measurement. So initial measurement, way back in IAS 16, we said the initial measurement is the purchase price plus any attributable cost plus the site restoration cost, or what we call decommission cost. Site restoration cost or decommission cost. So that relates to what? IAS 16. The purchase price, attributable cost, plus what? The site restoration cost. But this one, we are not talking about we dismantling the place because it's our own property, right? That we are letting out to somebody or that we are keeping for capital appreciation. So it is not something that we are going to um, um, dismantle it. No, we are not going to dismantle it. So if that's the case, then this will go with what? The purchase price plus any what? Attributable cost. Purchase price plus any attributable cost. So here, the present value for dismantling costs and those kind of things will not come in. It's just your purchase price plus any attributable cost. All right. So here we talk about the purchase price. Then directly attributable cost. So for getting the asset to its intended use, any cost, so installation costs, legal costs, tax fees, non-refundable payments, they are all part of what? The attributable cost. If only it is directly attributable to you getting the asset to its intended use, then surely it is part of the cost. So basically, this is the initial measurement. Now, what about the subsequent measurement? Subsequent measurement. So if we remember under IAS 16, we said the subsequent measurement deals with two models under IAS 16, where we said the cost model and then the revaluation model, right? Investment property also have two models, which is the cost model again, and what? And the fair value model. The cost model and the fair value model. And the cost model, like we said under IAS 16, is just your cost less depreciation and impairment. So it's the same thing which applies here. We've done impairment, and I believe depreciation is something that we are aware of. So the cost less depreciation, less any what? Impairment, if any, right? That is if any. That is the cost model. What about the fair value model? So for the fair value model, we are talking about the fair value. So with the fair value, there's nothing like depreciation. There's nothing like depreciation. So anytime you want to find the fair value and then use the fair value, right? Anytime you want to use the fair value, you want to find the fair value and use it. So if you give me the property, if the property is for me, I'll just go to the market. How much am I going to get this at the market? If it is in my book as 1,000, I'll just go to the market and find how much we are selling that asset, right? Equivalent. So I just go. If they tell me that the price is now 1,002, then it means yes, I've gotten a fair value gain. So here, IAS 16, we're having what? A revaluation gain and revaluation loss. Here, we're having fair value gain and fair value loss. Fair value gain and fair value loss. And regardless of whether it is fair value gain or fair value loss, it's being taken to the POL. So in your mind, you are asking, but under PP, the fair value gain, we said it has to go to the OCI, then any loss can go and offset it. If the loss is more than that, where do we take it to? We now take it to our POL. This is not like that. Here we are saying that any gain or loss goes to what? The POL. Because under PP, the figures that we normally get from revaluation are deemed to be notional amounts. Because if I have a friend, valuer, if I just go and call that friend and tell him that, hey, my friend, try and then revalue this thing upward. Well, he's a valuer. So what he says is accepted. Right. But the question is, for fair value, it is a market value. It's not based on emotions. It is market value. That's the market value. So that one is more accepted in the POL than the revaluation what? than the revaluation method. So that's the idea. So any loss or gain will be taken to our POL. That is under the fair value model. Okay. So now we are saying that the subsequent measurement is dealing with what? The cost model and the fair value model. So in that case, we say the market value of the asset. At each time, we have to recognize it in our book using what? The market value, using the market value. So it makes the disposal of this very simple because we don't have anything at OCI for us to say that we are transferring to retained earning and the rest like we're doing at the IAS 16. This one, we just compare the fair value with the proceeds that we are getting to check whether we are making a gain or we are making a loss. Whatever gain or loss will go to the POL. Whatever gain or loss will go to the POL to be charged to our POL. If you get gain, POL. If you get loss, POL. Right. The same way under IAS 16, if we compare the carrying amount with the disposal proceeds and we get gain or loss, we take it to us, the POL. It's the same thing, the same thing here. So nothing has changed. That is why I always encourage that in learning the standard relating to assets, we can learn from this standard, move to this standard, then can move to the next standard because they more or less what relate, more or less relate. So we can learn it from this standard to the next standard to another standard. So we can start from maybe IAS 16 to IAS 40 to IAS 38. Right. Then it makes it that good for us to capture the issues over there. All right. So basically, this is the issues under IAS what? IAS 40, right? These are the issues under IAS 40. But let's talk about issues concerning what we call ancillary activities. Ancillary activities. So when we mention of ancillary activities, we are talking about a situation whereby a company is keeping their assets as what? Investment property. So they are renting it to, they are renting. For example, let's talk about these hotels. Normally, their buildings are being treated as if is what? Investment property. But if you go into it, they provide some ancillary activities. So what are these ancillary activities? So if I'm going to rent, those other services which comes as part of the rent is called what? Ancillary activities. So recently, we have service, apartment, and the rest. So you go there, you have people who will be doing cleaning for you, people who will be doing sweeping, and the rest. Those are what? Ancillary activities. So if I should go to a hotel and I pay the rental fee, but within that rental fee, there's something like food, there's something like network. So the other services that they are providing to me, we call it what? Ancillary activity. So we will compare the cost of the ancillary activities to the total amount that I gave out. Because the total amount I gave to them, it includes if let's say it includes these ancillary activities, we would want to see the cost of the ancillary activities as compared to the actual rent that I'm paying. If the cost of the ancillary activity is deemed to be more or very significant, then we say that whatever building that they're using cannot be used as what? Investment property, but rather owner occupied. And if we say owner occupied, we mean IAS 16. IAS 16 means we are using it for a different thing rather than what? For capital appreciation and then rental alone. So that is on ancillary activities. As I said, like the hotels, you will pay, let's say, 1,000 cedis, but the other services, network, room services, and the rest that they do for you, if you add it together, it's even more than what the 1,000 Ghana that you paid. So what does that mean? It means that auxiliary activities is more than what? It's more than the rent. It means significantly they are using the building for what? For that services, but not just the renter. The focus is on that services and not the renter. It is so significant to the sense that it's even more than what the rent you are paying. Then we are saying that that building cannot be classified under investment property, but rather PP, owner occupied. And you know how owner occupied is being treated or PP is being treated. You may be using the cost model or the revaluation model. You get revaluation gain or revaluation loss. If cost model, you depreciate and then you check for what? You check for impairment. So basically, yes, the idea of investment property. But we have some scenarios that I want us to deal with. So let me try and see if I will be able to share the scenarios. But before then, what are some of the examples when we talk about investment property? Let's try and then get some 3 examples. We've mentioned that it may be a building, right? It may be part of a building. It may be a land or even land and building together that we want to let out or want to leave it for what? Capital appreciation. So like if I have a land, let's say I bought a land somewhere far away, and the time I bought it, the place was a bush, right? I don't have the intention of selling it. I have the intention of what? Renting it to others for them to use or leaving it there for capital appreciation so that when time comes, I'll go and what? Sell it. If I have a land and I purchase that land, let's say 10,000, and now I've seen that people have come to build hotels, stadiums, houses across the land or around the land. What will happen? There's no way I'm going to price it 10,000 again. You will say a hobby. So now the price will have to go up. That's why we say capital appreciation for capital appreciation. That is the idea for capital appreciation. So let's have some scenarios on the initial measurement and the rest so that we can end our session on IAS 40. Okay. Okay. So let's have these scenarios. So if you look at this scenario, question 1 is basically on initial recognition, as we mentioned. On 1st January 2024, Accra Limited purchased a building for 4.5 million. We are going to use 4,500 so that we ignore the 3 zeros, right? Additional directly attributable costs included legal fees, property transfer taxes, and then renovation costs before letting, right? Renovation costs before giving it out. So it means the total cost of the asset is what? Is the purchase price plus what? All these attributable what? All these attributable costs. If there's any refundable what? Cost, then we have to subtract from it. But here, we don't have any refundable cost. So let's go to our board and then try and deal with this. Okay. So we have Accra Limited. So the purchase price was 4.5. And then I think we have legal fees. Aside the legal fees, we also have property property transfer taxes. And then we also have renovation fee. Okay, renovation costs. So renovation cost is 150,000. This is 100,000. And then we have 50,000. So basically, this total will be a cost. So 4.5 plus 50,000 plus 100,000 plus our 150,000. That gives us 4.8. So this is the cost of the asset. It's an investment property. So we are not going to do what? We are not going to depreciate. We are not going to depreciate. So this is the initial cost of the asset. So initial recognition, that is initial recognition or initial measurement. Sorry, that's the initial measurement. So let's look at another scenario on the initial measurement. So another scenario on the initial measurement, this one we are talking about initial measurement with deferred payment, right? So initial measurement with deferred payment. We are not going to pay right now. We pay it what? In future. So I remember, if you quite remember when we were dealing with consolidation, the consideration, we dealt with deferred consideration. So this is more or less the same as what deferred consideration, right? Deferred consideration. So if you know the idea of deferred consideration, that this is the same thing. Something we are going to pay in future. Something which is going to be paid in future. So on 1st January 2024, Kumasi Limited acquired an investment property